Every gold investor watching this video is about to make the same mistake Henry Vanderhoff made in 1979. He was right about everything: the dollar, the inflation, the system breaking. And he still watched his brother-in-law retire 7 years earlier with 3 times the money. The difference had nothing to do with intelligence. It had everything to do with one number. And that number right now is sitting at a 100-year average, which sounds safe, which is exactly why it's dangerous. Who is Henry? What is the number? Why is safe dangerous? If that already sounds familiar, like something you've been ignoring in your own portfolio, drop a comment with your current gold to silver ratio, just the number, 0 if you have none. We'll come back to that number before this video ends. Here's what's actually happening. For 100 years, the number of ounces of silver required to buy 1 ounce of gold has averaged 60. Right now it's sitting at 58. That's not a warning sign most investors would notice. It looks stable, it feels normal. But across 500 years of recorded monetary history, every single terminal debt cycle, without one exception, that ratio has collapsed. Not drifted, collapsed. To somewhere between 16 and 40 before the cycle resolved. Sometimes lower. From here, one of 3 things happens. Gold falls dramatically. Silver explodes upward. Or both move toward each other simultaneously. There is no fourth option. The math is not a forecast. It's a structural constraint built into every monetary transition in recorded history. And here is what almost nobody explains correctly about why this matters more right now than it did in any previous cycle. Why this matters more right now. If this is the first time you're hearing the gold-silver ratio framed this way, share this video with one person who holds gold. Not to tell them what to do, just to make sure they've seen the data before the window closes. That's all. Silver is not a smaller, cheaper version of gold. That misunderstanding is what cost Henry Vanderhoff 7 years of his retirement. Gold is approximately 95% monetary. Investors, central banks, stored wealth across India and China. Gold's price is driven almost entirely by what people believe about money itself. Industrial demand for gold is roughly 5% of total usage. Silver is structurally different. Roughly 60% of annual silver demand is industrial. Solar panels, medical devices, electronics, electric vehicles. The data centers being built right now to run artificial intelligence cannot be constructed without silver. The solar industry alone consumes approximately 20% of annual mined silver supply every single year. And that demand is structural. It cannot be substituted away quickly. The thin film technologies the industry hopes will replace silver are still years from commercial scale. This means silver has 2 engines pulling its price upward simultaneously. The monetary engine that drives gold, and the industrial engine that does not exist for gold at all. When the monetary engine fires alone, silver and gold move together. When the industrial engine fires alone, silver moves while gold stays flat. But when both engines fire at the same time, which is exactly what the data shows right now, silver does not merely outperform gold. It explodes relative to gold. The ratio collapses, and the investors who held only gold watch the entire transition move past them while their position appreciates modestly. The historical record is not subtle. From 1979 through 1980, gold went up approximately 3 times. Silver went up approximately 17 times. From 2008 through 2011, gold rose roughly 160%. Silver rose roughly 450%. The pattern repeats. When the monetary transition is severe, silver multiplies. When it's mild, silver merely doubles gold's performance. By every measure currently visible, $38 trillion in government debt, interest payments exceeding $1 trillion annually, central banks accumulating gold at 50-year highs, an active war threatening 20% of global oil supply, the transition underway is not mild, and silver has not yet repriced for any of it. Now here is the part the demand picture doesn't even fully capture, because what's happening on the supply side is actually more structurally dangerous. Roughly 85% of newly mined silver comes as a byproduct of mining for other metals: copper, zinc, lead. Silver miners cannot simply increase production when silver's price rises. They are dependent on the primary metal demand at their mine. If copper demand stays flat, silver supply stays flat, whether silver is at $76 an ounce or $300 an ounce. The above-ground inventories of silver in London and Shanghai have been thinning for 3 consecutive years. The COMEX warehouses are being drained. Industrial buyers are taking physical delivery and not returning it to the system. This is what a structural supply deficit looks like before it becomes obvious in the price. And then there is this. Banks currently hold approximately $4.4 billion in short positions on silver. To close those positions at current prices would require years of mine supply, almost all of which is already absorbed by industrial buyers. The math of unwinding those positions is the math of a price spike that does not stop until physical buyers walk away. And industrial buyers, the ones running factories, building solar farms, wiring data centers, cannot walk away. Bank of America's head of metals research has a price target of $39 per ounce on silver. Goldman Sachs is at $100. Citigroup is at $110. JP Morgan is at $81. The cheapest major bank target implies silver more than doubles from here. The most aggressive implies it goes up 400%. These are not fringe forecasts. These are the most conservative financial institutions on earth publishing these numbers right now. Stay with me, because what comes next is the decision that separates the people who understand this from the people who actually benefit from it. And those are not the same group. Third decision almost nobody is making. Before we get to the 3 decisions, like this video right now, not because it helps the algorithm, though it does, because the next video in this series covers specific silver mining companies, the ones with the strongest balance sheets and the highest leverage to this move. If you want that list when it drops, the like is how the algorithm knows to send it to you. If you own gold today, you have 3 decisions to make, and making them in the wrong order is the single most expensive mistake in this environment. The first is the rebalancing decision. If your gold has appreciated significantly over the last 24 months, you are overweighted in gold relative to silver, not because you made a bad call, but because gold ran. The current ratio of 58 tells you relative pricing. Your portfolio's actual ratio may be 100 to 0. The first move is not adding new money. The first move is rotating existing gold gains into silver at a ratio the historical data suggests will repeat, not selling all your gold, rebalancing. If you have $10,000 in gold and 0 in silver, the conservative historical answer is 15 to 25% rotation. The aggressive answer, given the current macro backdrop, is 30 to 40%. The principle does not change with your account size. The percentage might. The second is the instrument decision. There are 3 categories of silver exposure, and they are not interchangeable. Paper silver through ETFs. SLV tracks spot and is liquid. PSLV holds allocated physical silver in vaults outside the banking system and typically trades at a slight premium to spot, which reflects the security of that structure versus a paper instrument. Silver mining equities through something like SIL. When silver moves 10%, miners typically move 25 to 40% because of operational leverage built directly into the business model. A miner producing at $20 per ounce and selling at $76 earns $56 per ounce in profit. If silver reaches $100, that profit becomes $80. The selling price rose 32%, the margin rose 43%. That is structural leverage without borrowing a dollar. And then physical silver, the only asset in the list with 0 counterparty risk. If banks freeze withdrawals, which has happened in financial crises across the last century, physical silver in your possession doesn't care. The trade-off is liquidity and storage. All 3 categories belong in a serious position. The weighting depends on your risk tolerance and time horizon. The third decision, the one almost nobody is making, is the timing decision. And this is where most people destroy a position they were right about. Silver does not move smoothly. From January 2026, silver went from $71 per ounce to over $101 in less than 4 weeks, a 56% gain in a single month. Then it gave back 29% over the following 6 weeks. The people who tried to time the bottom missed the breakout. The people who chased the breakout bought the top. The volatility is not a flaw. It is the mechanism that transfers wealth from impatient investors to patient ones during every monetary cycle on record. The framework is not market timing. It is dollar cost averaging into a position size predetermined by your overall plan. You decide today what your target silver allocation should be. You divide it into 3 or 4 tranches. You buy on a fixed schedule regardless of price. If silver drops 20% next week, you buy your scheduled tranche. If it rallies 20%, you buy your scheduled tranche. The discipline produces the result. The prediction produces the loss. Pull up your brokerage account right now. Look at your actual position in silver versus gold. Write your gold to silver ratio in the comments, just the number. The behavioral research is clear. People who name a financial position publicly are significantly more likely to act on it within 30 days than people who keep it private. That is documented science, not motivation language. In 1976, Henry Vanderhoff was 58 years old. He worked as a tool and die supervisor outside Cleveland, earning $31,000 a year. He was not wealthy. He was disciplined. For 3 years, he'd read everything he could find about money. When the dollar left the gold standard in 1971 and inflation began creeping higher, Henry concluded correctly that the system was breaking. So he started converting 10% of his salary every month into hard assets. Henry chose gold. By 1979, he owned 190 ounces purchased at an average cost of around $140. His brother-in-law, Walter, watched him for 2 years, agreed with the thesis, but couldn't stomach paying $200 for an ounce of metal. So Walter started buying silver at around $5 per ounce. By 1979, Walter owned approximately 5,000 ounces, roughly the same total dollar investment as Henry's gold. By January 1980, gold hit $850. Henry's position was worth $161,000. He had made 6 times his money. He was the smartest man on his block. In the same week, silver hit $49. Walter's position was worth $245,000, 10 times his money, $84,000 more in Walter's account. Same thesis, same timeline, same conviction, different metal. That $84,000 invested in the S&P 500 from 1980 through today is worth approximately $11 million. Walter retired at 64. Henry worked until he was 71. Henry was not wrong. He was right about gold, right about the dollar, right about the system. He simply held the metal with one engine during the cycle that rewarded the metal with 2. By the time he understood that, his brother-in-law was retired and the window had closed. 2 types of people are watching this right now. The ones who will look at their portfolio in the next 72 hours and move, even partially, even cautiously, toward the data. And the ones who will close this video feeling informed and do exactly what they were doing before. Henry felt informed in 1979. By every conventional measure, he had won. He simply didn't understand that winning the gold trade and winning the monetary transition were not the same thing. The ratio is 58. The historical resolution is between 16 and 40. The bank targets imply 100% to 400% upside. The supply cannot respond. The short positions cannot be closed without a price spike. The industrial demand cannot be substituted away. None of this is hidden. None of this requires a prediction. This is the structure of the market as it exists right now. You have something Walter never had, the data before the move. What you do with it in the next 90 days is the whole thing. If this framing changed how you're thinking about your portfolio, consider subscribing. The next video covers specific silver mining companies, balance sheets, leverage ratios, entry points, no generic lists, the kind of research that takes days to do alone. It goes up in 48 hours. You don't want to find out about it 6 months after the move.